Good morning, everybody. Welcome to the Locke in Your Success Options Trading for Income Weekly Update for September 8th, 2014. Before we get going, we would like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And note that we are using hypothetical computer simulated trades in the presentation today, and that actual results may vary. If you're watching this on YouTube or some other venue, come on over to our website at lockingyoursuccess.com. Check out our programs, M3, Bearish Butterfly, ROCK, M21, group coaching, and Trading Triangle 101 coaching programs. And join our mailing list and get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. Okay, let's come out to the markets here, and we'll take a look at what's going on. Last week I was saying that it was kind of a toss-up as to the direction of the markets for the week, and I was slightly biased for a down move in the Russell, and apparently the market felt that way as well. We held a really tight range in all the indices last week and closed virtually flat. If we take a look at the SPX here on the weekly bar, very flat weekly bar, slightly higher for the week. NDX, the same thing, flat bar, slightly higher for the week. The Dow was a touch stronger, and if we just shoot over to the Russell was a little bit weaker. We were slightly down for the week. Russell actually got the most back and forth movement for the week, but relatively flat. So really good for being close into expiration with our income trades. Personally, I don't like this environment. I'm just kind of waiting for that big move to come that's going to really push the positions negative. So I'm looking to get out of my positions as soon as I'm fairly happy with the profit moving on. But as long as it stays this way, obviously we're going to be collecting some money fairly quickly. Do keep in mind, though, we usually get something big coming into expiration. So as far as for the future of the markets, what we're looking for is we're looking for the Dow to actually make a decisive breakout over its highs. I mean, it's slightly, I think, made a couple of very minor new highs last week, but in the whole scheme of things, we have not broken any kind of resistance point. The traders are still in confusion here, not knowing which way they want to push the market, and this is what happens when that's the case. We get conflicting technicals, we get kind of tight ranges sometimes, we get a lot of fake outs in one direction or the other. So as it sits right now, I'm just kind of looking for the Dow to have a decisive breakout to tell us that the markets are actually going higher. Barring that, what would I expect? I expect the markets to continue in a relatively tight sideways range with the Russell. Since it's been sideways in general, I expect the Russell to have the widest range. Where's it going if it goes down? Likely to this major trend line that we've been with for 4, 5, 6 years now. And if we go up, we'll probably likely stay under this lower trend channel right now. So any up move would likely stay under here, which would imply that the highest closing price I'd expect to see is in the 1205 to 1210 range, even if we do break higher. And if we break down to here, that'll probably be a relatively fast move, and we'll probably bounce. So on the downside, we'd probably close right about where we are now. So that's what I'm thinking going forward with the Russell. Again, bad news is going to move the market down relatively quickly. We got a lot of nervous traders. They've been climbing the wall of worry, as they say, just buying the market, waiting for the breakout. It's not happening, and the longer it takes, the more nervous they get. And when it does finally break out to the upside, you're going to get a very powerful move there. If it breaks to the downside because of some bad news, you're going to get a lot of people jumping out of the market at once, and it'll probably be a fairly fast down move as well. So that's why I don't like being in a high gamma position right now. I think it's kind of risky. I'd rather be out in October, but that's what we have. That's what the market has dealt us at this point. So, okay, can everybody hear me? Thank you very much. I had one person who said they couldn't hear me, so I just wanted to make sure that that was okay. If obviously they'll have to sign out and sign back in if they can't hear me, because I can't talk to them. Okay, so that's what I'm thinking of with the markets. We're still kind of in confusion. We have crossing technicals We really have, don't have anything to say. There's no good opportunities in the markets to take a hard direction, stance on a direction either way here. All right, if we take a look at our positions, I'd like to start with one that I closed last week, which was the September Bearish Butterfly. Coming into the week on Tuesday, because we had a holiday on Monday, this is what our position looked like here. We basically had we had 10 1160s, we had 10 1180s, we had 5 1140s on. With the gap up, it put us, if you remember, we were in expiration guidelines, we're under 21 days to expiration. With the gap up, it put us at minus 611 delta, drew us down a little bit. So coming to the end of the day, what we ended up doing is selling off the remaining 1140s and starting to buy into our 1200s. So at the end of the day here, I'll show what that looked like. We got rid of the 5 1140s, went into 5 1200s. Then coming forward from there, I think that's all that happened. Yeah, so if we come to Friday, there were no further adjustments, and this is what the position looked like here. We were obviously started to pull back a little bit. We're about 208 delta positive, which is well within the guidelines. During the week, there weren't any adjustments. Really, the profit and loss this day was anywhere from like $4,000 to $7,000. It was kind of all over the place, which we've been seeing that a lot lately in the Russell. I think it's got a lot to do with the CBOE being the only option seller now, and we just get a lot of intraday price fluctuations, and you have to kind of go in there and estimate what your position's actually worth. And that's what I did here. And at the end of the day, I actually closed this out, and I closed it out at a profit of, let's see here, 59.11, which I believe is about a little over 11%, and that brings the trade for the year up to about 109% of planned capital, which is pretty much in line of what I expect from it. So another decent month. We've been hitting a lot of singles here with the Bearish Butterfly. We haven't really had any, well, we had a couple of good months in the beginning of the year, but recently the market moves have just been a little bit too big for us to really take a big profit out of here. The singles, though, have been doing us well, and like I said, we're on track for what we're going to do for the year. Okay, so yeah, I have a question. I'm asking for the T-log. Here is what we looked like on Tuesday. We sold off. I sold off the, because if you remember, during expiration we do intraday adjustments. Around noontime we sold off the lower butterflies at the 1140, flatten our delta out. At the end of the day we want to kick our delta down to, in this case it was minus 250. So we bought 5 of these 1200s to do that, and then this is going to look weird because it doesn't come out as butterfly positions. I usually take these off as different complex orders to pull the position down. So, and that's the rest of the T-log there. All right. So let's see. What do we have next? Next we have the ROCK trade. So if we go to end of day Tuesday, actually let's go to the beginning of the day Tuesday and take a look at the ROCK trade. As a reminder of where this was sitting, if you remember right, we are in regular ROCK position. So let me switch accounts. This coming into the week was 10 1140 butterflies, 10 1180 butterflies, 5 1200 butterflies. This is what our position looked like. Of course, we had the gap up. We started hitting maximum positive delta towards the end of the, well, actually in the middle of the day, but we didn't adjust this till the end of the day. If we come in here at 1500, what I ended up doing is I added the last, let's see, I'll move this down. Added in the last 5 butterflies at 1200, brought us down to around minus 180, which is about what I'm looking for here. And we were fully scaled in. And coming from here, I don't believe there is anything else. Thursday. So Thursday, the market kind of backed off a little bit. And we don't allow, when we're in that position, we don't allow, let me just go a couple, half an hour interval earlier here. We only allow a very small amount of positive delta in this position. So Here we didn't have a problem, right? Towards the end of the day, the market started to pull back, and since we only allow about 100 positive delta on this thing, we just pulled off 3 of these 1,200 butterflies at the end of the day. I don't know if we can see that positive delta here. Yeah, so we're positive 100 here. Actually, towards the end of the day, I think it was a little bit even further down. I think we were over 150 positive. So what we ended up doing is pulling down 3 of these 1,200 butterflies here on Thursday, and from there we really didn't have any further adjustments. So on Friday, if we come into this, we are positive 50 delta, which is perfectly fine, and we're looking at $4,142. We're trying to get 10,000 out of this. Realistically, if I get near that number, I'd like to be out. I just don't like the way the market's going. It remains to be seen if that's going to happen or not. I mean, it looks like this morning we get a slight down move, which would prompt us to pull out of some of these 1200s and eventually go back into a cat position, in which case I would lower my profit target to around 10%, or if I'm over the $5,000 level, I'll pull out of this. If I can stay in basically a rock formation or a 2/3 entered rock formation, I would go for the higher amount. If I have to go back into cat formation and I'm over 5,000, I'm just going to pull it, and it'll be the end of the trade. But from here, if the market's relatively flat, then we're going to go for the $10,000 number. And this is what we look like. All right, so what else do we have on for September? Oh, yeah, okay. So we have the September M3. Let me switch over to that account. That had 2 adjustments also. It had just a very simple adjustment. So if we go back to Tuesday morning, we'll swap over to, let's see, our September M3 here. This is what we look like earlier in the day on Tuesday. Again, with the gap up, we don't have a delta problem. And even here, we don't have a volatility problem. I think towards the end of the day we did, though. Let me just go to 1,500. So towards the end of the day, we are at 1179. Usually, when I'm going to roll this up, I'll usually roll this up if we're over 1180. And usually, a lot of times, I'll let it wait a day or two to make sure it's going to stay there. And then I'd be interested in rolling this up. I'm not really interested in rolling this up here. We're still under the 1180 level, and everything's okay. Our delta is actually okay, but our vega is somewhat positive. So from that, what we're going to do is just do 5 1140, 1150 verticals. And it's going to flatten our delta to about minus 26, which is still acceptable. Had that put that positive, that would be a reason probably to roll this up. Now, a beginner is going to roll it up. A more advanced person will do some other techniques that will help us keep our delta down and fix our vega at the same time. But beginner M3, you would do a roll up at that point. Wasn't really required here. So at this point, this is what our position looks like. And if we move forward to Friday, I actually did a few more of these verticals here. So if we look at our T-log on Friday, we did 2 more. We did 2 1150, 1160 put verticals, and that was a delta correction technique. If we go in a half an hour before this, what we were looking at is, well, okay, it wasn't that way a half an hour before, but at the end of the day, my delta was a little bit. Oh, actually, I've already done this. Hold on, what time did I do this? Oh, I actually did this at 2 o'clock. So let me back this out. Or just after 2 o'clock. So just after 2 o'clock, you can see our delta number is about minus 77, which is fine if I'm inside the tent, but I'm outside the tent. And I usually like to keep it down around closer to the minus 50 level outside the tent. So I did do these 2 verticals, which put us by the end of the day at about minus 56 delta, which is pretty much fine, and 1773 profit and loss. And this is what the position looks like here. Again, if I get too close to expiration here, much over 5%, I'm willing to close this and move on. We are coming into expiration, so I tend to get happy with a little bit lower profit here if things don't go well. But so far everything's going fine. That was the M3 for September. So speaking of the M3, I just have a question. For the M3 position, this close to expiration, do you try to keep within the 10, or do you still let it go outside? Okay. Yeah, so do I try to keep this in the 10, or do I still let it go outside of the 10 or 20 points? Essentially, I will let it go outside the 10 as long as I think I can control my position out there. So in other words, if I can maintain positive theta, a negative vega, and a somewhat negative delta at the same time, then I'm perfectly fine being outside the 10. Usually right up until expiration, and sometimes completely until expiration. Because what I'll do here, essentially if the market sits here and does absolutely nothing, my delta is going to increase, and I'll gradually just bring these out, right? And gradually flatten my delta, gradually flatten my delta. At some point, if the market stays there, I'll either start taking out these 1170 puts, so in other words, instead of being there, I'll be all the way up here. And if that starts to create a delta problem, I can drop out of my call. Now this is kind of limited because it's a very small position. It's only a 10 lot, but let's see, where is my call? There it is. And then eventually you drop out of your call, and you put yourself into something like this, where if the market continues up, you just pretty much take what you get, what you have, and of course, or let me reword that. As the market goes up or as the market sits here, I just continually roll these back. So I'll eventually go like -8, +8, right, and just go more and more into a vertical spread. And as I can take on downside risk, like I wouldn't do this today, but certainly if we go ahead in time to the 5 or 10 days here, then I'd be willing to eventually take this out and go into a formation that kind of looks like this and more or less let it expire. And if it pulls back into this range here, I still hit my profit target or maybe a little bit more money. If it stays or continues to go up, it runs flat. So that's generally the way I like to handle these into expiration. Now, if I wanted to get really punchy, I could roll on top of that, but you have to remember you're basically trading a weekly trade. So in other words, if I decided to actually take this and roll it so that I'm up into here, let's just do this as a sample, right? If I actually pull this up into here, that wouldn't work. I'd have to go, let's see, -10. I'd have to do something like this, +8. Or I could do something like that. Let me just try 4. Right, I could do something like this and pull myself on top of the market, which isn't a terrible move. Puts my capital up a little bit, but if I get really close to expiration, I can do something like this. The issue is if you're getting this market where the market's just kind of grinding up every single day, you're going to eventually fall into this hole. What I'm doing is I'm taking the hole, I'm making it deeper, I'm moving it forward. That's okay if you think you're going to stop, but if you continually move up, you're going to have a challenge here. You may end up taking a small loss to the upside. That shouldn't be a big deal. My more concerning thing about doing something like this, right, and this is what I would call getting aggressive with the position, my more concerning thing is I'd be very concerned with a harsh downside move. You get 20 or 30 points, it's not too big a deal, but if you start pulling 40+ points to the downside, you're a whole lot better off in your existing position than you are in your newer position here, which is going to give us a whole lot more downside risk. I mean, I guess, thinking about, if I'm looking at this, I don't even mind this position so much because this is a minor enough adjustment. What I'd hate to see people do is go right on top of it. Like sometimes they'll move right up into, maybe do maybe 20 points or even 10 points behind the market. And they give themselves a ton of risk in both directions, and that's pretty risky coming to expiration. I mean, it pays off if you're good at handling weekly positions and you reduce your position size enough where you're comfortable taking a bigger than 10% loss, then I might be willing to do that. For people who are not quite so adept or are maybe working during the day or sleeping or whatever, I'd much rather be in more of a position where I am now, or as if I was going to get more aggressive, I could do something like this, or maybe something in between where I am now and where I am here, which is stuff that we talk about when we get more advanced. But that's something you could do. Generally, I'm not concerned, though, as far as me being concerned about losing money. I'm not even the least bit concerned about losing money in this position here. It's going to take a really, really big down move to do anything for me to the downside. And realistically, if the market stays up here, I'm just going to gradually take this risk out while holding my downside and take what I can get. So it all depends on if the market's going to cooperate with us or not. So that's pretty much how I would handle that. Okay, so let me close this. I think I have everything cleared out. That is not all the September trades. We have one more, which is the September V Condor, which is kind of boring. Nothing at all has happened here. We're sitting in a position we've been in for a little while. If you take a look at our T-log, last adjustment was on the 26th of August. This here is just waiting to expire. Could I close this? Yes, I could close it if I wanted to at about where I'm going to expire it. There's a possibility the market creeps up into here. I'm absolutely not concerned whatsoever of hitting either short strikes. And I'm just going to let it close. When it expires, we will move on to November, almost the end of the year. Wow. So that's the V Condor there, no adjustments. And let's just push into our October V Condor since we're in V Condors. This one here had, I don't think we did anything here. I could be mistaken. Nope. We bought back a couple of those short, we brought back one of those short 1230s, I don't know, a week or so ago. And since then, the delta's been pretty flat. So no need to do anything here for the week. So this is in the same position, up about $1,000, $1,400. This is what we look like. And everything looks fine, so no issues there. We have the October M3 again, which I'll just show you where we are now because that had no adjustments because of the lack of market movement and being far from expiration. This is what we look like here. This is a really, really nice looking M3 trade. So, I mean, the risk here of a major market move is pretty slim. And then, of course, we have the October Bearish Butterfly, which did get an adjustment because of the constant grinding up move on, let me see what day that was on. On Tuesday, we did the roll from 1140 to 1160. So if we just shoot back to Tuesday here, I'm not sure what time of day I actually did that. But we were having delta theta problems by the end of the day. We actually have it even now. At 2 o'clock. So if we take a look at the T-log, all we did is we sold out of 1140s. We did our delta theta roll up to 1160s. And this is what our position looks like as of today. So we were down almost $1,200 on Tuesday. And with the flat market, Friday afternoon we were up about 800. So this trade is doing well also. I actually like this trade this month. And if we have a really strong breakout, we're going to have a little trouble chasing it if it comes too late into expiration. I don't really think we're going to get that. I think we're going to continue sideways, so I don't mind the trade so much. So that is and that's it. That's all the trades we had for the week. That's the Bearish Butterfly. So I have a question on how the V Condor is done year to date. So as far as results, so I think I have that up. I think this is it here. So the V Condor this year has been because of the V Condor. What it likes is it likes smooth uptrending markets. It deals okay with a relatively large amount of chop, but the distance or the traveling of the price movements from top to bottom have been kind of extreme. So it's been kind of a tough year for this. I think last year was up in the 60+% range. This year here, as of the close of August, we're up 11.9%. This month is going to probably close out at 3,400, which is going to be, let's see, another, I don't know, 7 or 8%. So it'll be probably close to 20% by the time we close September. October, I don't foresee a problem there. Enough time's gone by where the likelihood of that taking a loss is very, very, very small. So I would expect another 20, so mid-20s. And the remaining 2 months, it'll probably return around 25% for the year. That's my guess this year, which is below normal. My expectations for it are in the 60 range. Well, like I said, we had too much back and forth movement in the indices for that particular trade. Last year we had a above normal trade, and it did really well last year. But that's what we're running for this year. And all right, so in the ROCK trade, if I start out as an M3, am I constantly looking at the delta to get into a ROCK trade, or are you looking for technical levels in the Russell? Or okay, so if you go with the program guidelines with the ROCK trade, if I enter a ROCK trade as an M3, I do not put that into a ROCK trade position until the market gets at least 10 points over the long strike. So if I was looking at my October M3 and I was pretending this was a ROCK trade, that I started out if I was pretending this is a ROCK trade that I started out as an M3, I'm looking for the market to essentially outrun the M3, which means I'm looking for the market to pull up into over 1190, at which point I will check the delta to see if I should remain in an M3 style trade or if I should go into a ROCK configuration. So that's how that goes. So it doesn't really matter what's happening for the duration of the trade if the price stays down. If the price stays down, we're just going to treat this as a regular M3. That's because usually if the price is just kind of hanging here like this, it's when the market's in confusion. And if the market's in confusion, I would rather be in a flatter gamma trade. Like I said, right now, even though in the last week or so your high theta trades have been doing pretty well because the market's been so flat, it's actually a fairly risky position to be in. So to be high theta. So I'd rather stay in this type of a position, wait it out until the market actually takes off. If the market takes off to the downside, or remain in an M3 because the volatility is likely to get high and remain high. If it takes off to the upside, I'm usually willing to go into a ROCK trade if my delta says it's okay to do so, and start to take advantage of the volatility drop in the grinding up market, which the ROCK trade tends to do okay in a grinding up market as long as it's not too fast. That said, I could add technicals to it and say, hey, if I think the market's going to go another 50 or 60 points, then I'm going to stay in an M3. But in general, that's how it works. All right, so the next one here is if you do that, if you do a delta roll in the bearish butterfly, why not reset the control point since you're essentially starting to trade at a higher level again? You can do that if you are of the opinion, in other words, if you were doing a guidelines bearish butterfly and you were at a support level and you were of the opinion that the market was really going to run on you, that is one of the techniques that I will use at times to try to lengthen or increase the upside range of the trade. I might do that. In the guidelines, though, essentially we want to get scaled in at some point, and the scale-in point is, and so we keep the same reference point because we want to get scaled in at the same time. Like that would have Andrew, like that would have worked out well in a market like last year that just kind of kept going up, kept going up, kept going up. That would have helped kept your losses down on the up moves. But on a more normal market, where the market doesn't have these extended moves, you want to get scaled in a little more because that way you get your money back faster when the market flattens out. So either way is fine, but that's the way that's the reason we do it, is in it because what we do is we try to make the trades adapt to a market that's as normal as possible. And a year like last year wasn't. In a normal market, you're better off scaling it. All right, so the October M3, how do I know if I should roll the 1130 to 1140 or roll the 1150 to Oh, okay. So it's asking me, how do I know if it's asking about vertical adjustments. If I'm going to do, add verticals into this, so how do I know to use an 1140, 1150 versus 1150, 1160 or whatever? You know, what verticals am I going to use? Typically what I'm going to do here is I'm just going to work my way off my center strike. This is the way that I do it in the programs. There are reasons to do wider strikes, fewer wider strikes versus more shorter strikes. There are reasons to do that we probably can't get into here. It's going to take all day. But essentially the way I'm treating this within the program and here is that I'm treating this as two vertical spreads, right? A bullish vertical spread and a bearish vertical spread. And as I run into delta problems or vega problems, I start at the center and I'm willing to move up to 10 of these. So the center of my strike on my butterfly is 1130. I'm willing to move up to 10 of these, and I'm going to move them as needed to correct this. So in other words, as I continue to have delta problems, I'll bring these up to here. And then once I have all 10 of these that I'm willing to roll at this strike, I'm going to take 5 more or 10 more or whatever. I'm going to roll them up to the next 10 points. Then I'll roll them up the next 10 points, and I'll roll them up to the next 10 points until I'm all the way to here. Right? At which case, I may or may not need to roll the position. But that's what I'm going to do. So I'm not going to take and there's nothing wrong with doing the other thing. It has pluses and minuses to taking 5 of these, or maybe even 1 of these, right, and moving it all the way up to here, rather than taking another 5 from here to here. There's pluses and minuses to doing this. Again, it takes too long to discuss out here. That's something we would do in like a group mentoring session or something, or a one-on-one mentoring session. I could explain that thoroughly, but there's a difference in doing that. Not that either one of them, they're both acceptable. They will both accomplish a similar thing. So and you can do just as well pretty much either way. But this is the way that we show it within the program. All right, so is it useful to start an M3 October trade now, or it would be, yeah, if I was going to go into a trade now, it would be an M3 trade. Yeah, so an October M3 now is completely fine. And let's see, I have one further question. It says, last Friday as I closed my first M3 trade, as I mentioned, errors will happen, and one did. Because of the adjustments, I did not have a clear butterfly to close, but 2 spreads during a period I expected a quiet market, but already then it started to move quickly. So after that, the following question came to mind. How can I detect positions in risk at any moment in time? I'm not sure I understand that question. Are you on right now? Okay. I think what you have here, right, is you're basically asking a question on how to get out of a position, right? Okay. So, all right. So to get out of this position here, right, and I can't get too into this, but I can get somewhat into it. So we have a position here that is not a butterfly formation. And even if this position was kind of crazy, like it was something like this, let me just say we have this position here, right, which is something that's possible, right? So you could have a position like that that's fairly complex. So if I wanted to exit this trade today, right, what I'm going to do is I'm just going to try to exit this in the flattest manner that I possibly can. And I want to get away from the fact that, hey, I have 2 spreads or whatever. I just want to exit this as flat as I can. So right now I have too much negative delta. I want more positive delta. So I could pull off two butterflies maybe, -2. Right, and that's going to bring my delta to neutral. Right, that's going to put me in a position like that. So I can convert that. Now from here, I want to start pulling down these in a condor structure. So, or I can do it in a broken wing butterfly structure, but essentially all I'm doing is I'm going to put these really complex orders in. And yes, they will take these orders. Yes, they will fill the orders. You have to learn how to price the orders, though, which is something that we do in a program and we can't do necessarily here, right? So this might put me more positive delta than I want, so maybe I want to go, maybe what I would do is, if I had multiple positions, I can do this a little easier, but what I could do here is I could put myself at maybe positive 50 delta and then drop out of a call, and that will put me at back flat again, and I can do that relatively quickly. In other words, I can rock this because this is where I have my power right now. I can come in here and I can do maybe 6 plus 6. All right, this puts me at positive 90 delta. But what I'm going to do here is I know that this is going to be difficult to get rid of. This is going to be easy to get rid of. So I brought my first move brought my delta down to almost flat, which is what I wanted to do. The second move here is this going to be hard to fill this. So, and it's going to be easy to fill this one. So what I want to do is I want to almost put it in a contingent order to fill this call as soon as I get out of these. So that's what I'll do. So I'll fight for the price on this complex spread, and then I'll drop out of the call, and I'll do it immediately. And I know I'm going to take a bad execution on the call. That's my plan. So I'm going to get, but this thing is hard to fill. I'm going to take a good execution on this, and really, if nothing happens, it's not a problem for me, right? Because I'm perfectly fine in this position overnight. All I did is I reduced my position size a little bit. So. And then I fight to fill this, and I immediately fill this afterwards. Right, and now I'm in a position that looks like this. Right, this is a very, again, it's very close to the position that we had before. It's actually a lot safer position if from here I don't. So that was the riskiest part of the whole exit. So from here, I just kind of pop out of these one at a time. So I can do, I'd probably get rid of one of these, right? So +1, -1. Am I short something? Am I net short something? What am I missing here? No, everything's fine. So, right, so this puts me at slightly -19 delta, not a problem. Convert trades. That puts me in this trade here. I'd probably -1, +1, and then -1. That's going to put me at -12 delta into this position here, and then I just close. Then I can just close the last spread that I have. That's probably the easiest way to close this, because you never really take on any real risk here. This risk here is minimal. You don't have a risk of losing a ton. But that's probably how I consider closing that. I mean, there may be a better way, but the point is just to play around with your positions, think creatively on how you can enter your positions and exit them at a flat a delta is possible. A lot of times you'll have to do something with the call. That said, though, I mean, if you don't want to do anything with the call, if you want to take the risk of dropping out of that call, let's see, this was done 9/5. Let me delete. Try not to goof up my stuff too much. If you don't want to take the risk of dropping out of that call, let me do this. -3, sorry, +3, -1. If we happen to be in this position here, right, I'm -91 delta. I can -10 of the, let me do 7. -7 +7. That's going to kick us to +80 delta and then drop out of this call. Kicks us to 19. It puts us in this position here, which is very similar to what we had before. Right, so you fill, so if you wanted to do something easier and you want to just take your risk down, you fill this spread, pull that off. Trades. Now you're in this position here, and from there you basically do the same thing. You work with pulling out one condor at a time till you end up in just this bullish vertical spread, and then you just drop the rest of the spreads out. And if at any time you have to take a couple extra spreads, like in other words, you might do one condor, take a spread, do one condor, take a spread, do one condor, take a spread. Whatever you need to do to keep your delta relatively flat, and that's a lot safer way to exit than trying to pull whole butterflies off and going way positive delta. If you know you have to pull a bunch of butterflies and go way positive delta, the best thing to do is purposely just take a hit on the call. So figure that in your exit prices. I'm going to do really well on these complex spreads. I'm going to take a hit on the call to get flat delta, and from there you can usually walk your way out relatively flat delta without taking on too much directional risk, and that's hopefully that's helpful to you. And the last question too would be, say you only have mobile access and you're at a job or you're sleeping. What you want to do is you never want to try to do really complex options or trades where you're switching your delta, like you're dropping out of butterflies and you have to sell a call. You don't want to try to do fast trades like that on your mobile device, or if you or trying to roll a butterfly or something like that. You just don't want to do it. So what you do instead is just buy. So if you're running into a downside problem, you just buy puts, or if you're running into an upside problem, you can just buy some in-the-money calls to flatten your position out, and then come back when maybe the following day or whatever, when you actually have time where you can access the market, and then do your roll. So this position's so flat, I don't really have a problem. But if I started running into some sort of an upside problem, I can always maybe add another call here, or I could, if I have a problem with the downside, I could just buy a put back. Because you are such small position size, you may actually have to buy a call up in here somewhere. But essentially, the thing is, on the mobile device, you do the simplest move possible to correct your problem, and then you come back in and you fix it later. All right, and let's see, that's 9:46. I think it's about time for us to get going. Other than I just have a comment that they're finding it difficult to get filled on complex positions. Yeah, Daryl, we have a whole, if you look at the M21 program, we have a way of pricing stuff out. We got to go into how mid-pricing is not the real pricing, and how to determine real pricing in the in whole sections and execution, and we could go over that, but you can get filled. I'm in control of, I don't know, a couple $1 million in the market, and I do live complex fills all the time, and I get them at pricing that the pricing that I expect, which is sometimes much better than mid-pricing and sometimes worse than mid-pricing, because you have to look at what mid-pricing really is. In other words, if you come in and you look at your pricing, your calls, your puts, your iron, and your inverse iron positions, when you do these complex things, you can get an idea of where the price should fill. That's the real market price for that. And if the market's moving around decently, you can get filled really, really well on that stuff. If the market's really grinding and flat, then it's difficult. You have to give up some money, because the market makers take money to cover themselves. But it can be done. Part of it, if you're just looking at mid prices and you're hitting it in order at mid price, you may be getting taken advantage of drastically, or you may be looking at a very unrealistic price. So there is a procedure to go through to do that. And execution, you're going to find, as you do this stuff, execution is an art in itself, and that includes just buying a call. Sometimes you can buy calls at well under mid-price. Sometimes you have to pay over mid-price. It's a matter of knowing when to hit it below mid-price, when to hit it at mid-price, and also timing your adjustments so that you're not trying to force an adjustment. So if you're in a position where if you put yourself in a position where you have to have this adjustment and you have to have it now, and the price is going against you, you are not going to get filled at even a fair price. Even if you do all these calculations, you're not even going to get filled at a fair price. But if you know when you want to adjust, and then you pick your time to do so, you can get filled at much better than mid prices, so or fair prices. So anyway, that's what I have for the day. Thanks for sticking with me for, oh gosh, almost 50 minutes today. And hope everybody has a great week. We'll talk to you next week.